Private placements are an attractive way of an attractive means of raising capital, by companies, especially those in the startup stages, or other smaller firms, without necessarily going through the complexity of adopting the initial public offering means. Instead of going through the route of an initial public offering or IPO, a startup or a new company or a smaller company can decide to raise capital through a private placements. We want to talk about the key features of private placements every investor should understand. What are the key characteristics of this means of raising capital? Number one is targeted investors. Targeted investors. Private placements are typically offered to a target group of what is known as accredited investors, which may include institutions, like pension funds, like insurance companies, or venture capital firms, or maybe high net worth individuals who must meet a specific financial criteria. So these are the targets of typical private placement, process. Number two is less regulatory oversight. Less regulatory oversight. So unlike public offering, private placements are not, subject to the same level of regulatory scrutiny or oversight. Usually in a public in an IPO, the scrutiny is also much, but in a private placement, they have that leniency. They don't really pass through much scrutinies, from bodies like the SEC. This reduces the administrative burden and accelerates the capital raising process, but it also means less transparency and fewer kind of investor protection. The process is less transparent, not as transparent as initial public offering. And in this context, you discover that there's less investor protection. Number three is customization of terms. Customization of terms. The terms of private placement, such as the price, the interest rates, the maturity, and other conditions are flexible and can be tailored to meet the needs of both the issuer and the investors. They sit down together and negotiate, with each party trying to satisfy the needs of the other party. And so this customization is a key advantage of private placements over public offering. There's room for private negotiations when it comes to the terms and conditions involved in the entire process. Number four is confidentiality. Confidentiality. Companies raising capital through private placements often benefit from a greater level of confidentiality. There's no need for the same level of public disclosure as is obtainable in public offering, which help to protect sensitive uh, financial information or strategic information of the company. So it is done that way actually. So that confidentiality is there. The people who are participating may not know them, and even the company may not be that popular because everything is done like in a, should I say, hush hush, fashion or what. Number five is limited liquidity. Limited liquidity. So securities sold through private placements are typically not listed in the public exchange. They are not listed typically. They don't list them in the public exchange, which means that investors may find it very difficult to difficult to dispose their position or to exit their investments whenever the need arises. Find it very difficult to sell. This limited liquidity is is a consideration for investors, as they may not be able to exit their investments easily or quickly. Number 6 is a fewer disclosure requirements. Issuers of public of private placements are not required to disclose as much information. There's that kind of restriction when it comes to information disclosure compared to what you have in the initial public offering. They tend to disclose less. They don't really talk much about themselves, actually. And so while they still need to provide necessary financial and legal disclosures to investors, the requirements are less stringent. They don't just provide everything like what is done in a public offer. Generally, you have very thick brochure. All necessary information are disclosed in a brochure for public offer, or a prospectus for a public offer. But we don't really have that in private placements. Number 7 is investor qualifications. So private placements are usually restricted to qualified or accredited investors who meet certain, they are within certain income brackets, or asset criteria. It's not just for everybody, for people who have the wherewithal. So this limits participation to those who are deemed capable of bearing the higher risks associated with this kind of investments. They are generally for people who are quite rich and they can bear investment risk. Please subscribe to this channel and like this video if you've not done that. It will do me a ton of good. It will motivate me to keep on bringing contents of this nature to you. Number 8 is potential for higher returns. So in this case, investors in private placements may have the potential for higher returns, especially when they are investing in the early stage or the growth phase of companies that are not yet publicly listed or publicly traded. However, these investments are typically high risk as well. That's why you need qualified investors, accredited investors, because not everybody, not the general public cannot really stomach the kind of risk that emanates from this kind of companies. Then number 9 is types of securities offered. So private placements can involve a variety of securities, including equity, that is common or preferred stocks. It could be debt instrument like bonds, or promissory notes, and may also involve convertible securities such as convertible bonds or preferred stocks, which can be converted into equity at a later date. You buy these bonds, as time goes on, there's that particular advantage of converting the bonds into equity, into company shares at a later date when the need arises. Number Number 10 is no public offering requirements. No public offering requirements. Since private placements are not traded in public exchanges, there is no requirement for an issuer to go through the extensive process of a typical public offerings, including maybe roadshows, advertisement, promotion, and you don't really involve underwriters, and there's no extensive regulatory filings. You don't have that. And lastly, number 11, exclusive deals. Exclusive deals. The private placements can provide investors access to exclusive deals or early investment opportunities, especially in high growth sectors like technology, like real estate, or venture capital. So, in a nutshell, this particular kind of fundraising activities offers flexibility. It is fast, and they encounter fewer regulatory hurdles, compared to typical public offer. However, they come with risk, and risk in the form of fewer investor protection, because they're not fully scrutinized like other bigger companies coming through the IPO route. So there's that tendency that you could pose greater risk to investors because the level of scrutiny is quite low. And so investors are really there to bear the risk. That's why not everybody can participate in this kind of investment. It's meant for those who are accredited, qualified, as well as some institutional investors.